Yeah, hello everyone. My name is David Nichols. I'm a portfolio manager at East Capital for the Global Emerging Market Sustainable Strategy. My background is that I'm British, as I'm sure you can hear, but really I've spent my entire sort of career doing investing and living in emerging markets. So yeah, after university, I lived in Kyrgyzstan for a year and a half. Then did investment banking in London for a while, but really focusing on emerging markets. And in 2014, I joined East Capital in Moscow, where I helped build East Capital to be really the largest leading institutional investor in Eastern Europe. But of course, around that time, what we saw in sort of Crimea really made an effort to diversify. And my next sort of big role was to work for about a year with our CIO, Jacob, to create a sort of process and philosophy for a global emerging market fund that we launched in January 2019. And yeah, I've been managing it together with Jacob since then. And it's been a good ride with almost 5% annualized alpha since that time on a gross basis. In terms of what the sort of the fund and the team looks like, I'll share some sort of very high level slides just to give you a sort of a taste. So yeah, it's around 60 high quality companies that comprise the fund. I mean, really look at essentially what we're looking for is to find companies that will deliver what we call sustainable growth, but at a reasonable valuation. So it's sort of GARP strategy, if you want to pigeonhole it. But how we find those reasonable valuations is very much focusing on under-researched or maybe smaller companies. So approximately 40% of our fund is not in the index at all, and our active share is in the sort of 75 to 80% range. And that's because we typically see a lot more value in some of these going across the market cap range and not just the large caps. We actually generated a very large amount of our alpha from the mid cap space over the since inception basically. And one of the key aspects we're really looking to focus on when we created the fund and then the process is sort of very strong risk mindset, learning from our experience in managing other funds. And one of the really important aspects is being country neutral. So essentially we look at the benchmark and we try to match the country weights, particularly the large countries like China or in India and things like that. The reason behind that is really just lessons learned, and that we've found that we were good at doing the sort of the stock picking and portfolio construction, weren't so good at doing the sort of country timings. And yeah, that definitely played out in the GEMS portfolio as well. But what it means for our investors is that we have, despite this sort of strong stock picking, the high active share, the high off benchmark holdings, we're controlling for by far the major factor risk. So country risk explains 60 to 70% of returns of a stock. So we still, despite that stock picking, we still have a sort of tracking error of 5 to 6%, which we think is in the sort of realms of an institutional global emerging market product. In terms of sort of turnover and how we think about a sort of rapidly changing backdrop, yeah, we very much say we're sort of evergreen dynamic approach. It's not that strange to say emerging markets are volatile, but how you deal with it can be a bit different. And our view is that you actually need to react to what you're seeing on the ground. It doesn't work just to pick the companies that are going to be winners over 10 years, given the rapidly changing market dynamics, market structure, macro backdrop, and things like that. So we really try to introduce these sort of top-down factors and take advantage of them. The strategy was founded in 2016, as I said. Current assets of well above 500 million now. And I think one of the numbers we're most proud of is this idea of upside capture. We have 114% upside capture, but our downside capture is only 97%, which is very good for a sort of growth-focused fund. And the reason why we're first quartile since inception is not just because we've outperformed during the good times. It's that during the sort of more sell-offs, we've typically managed to deliver alpha, or at least not lose very much, which is why we've got this good downside capture ratio. So no, great numbers. I think that we're very proud of, and that's delivered this alpha that we mentioned here. In terms of, I'm now going to talk a bit about the team, which is obviously a crucial part. Yeah, we have 8 people in the team. led by Jacob and I, Jacob being the CIO. We work well together. Jacob's sort of more of a passionate stock picker, whereas I'm a bit more sort of skeptical about asset management, active management in general. You know, I've really seen where active management doesn't work, and so try to take on everything we've learned and I've seen, both by reading and also by practice, to try and avoid all the sort of the biases that creep in that mean that you can sort of not follow the process you set in, and that typically leads to underperformance. So yeah, we work well together from that aspect. In terms of the broader team, I think the most important thing is that 5 out of the 8 core team members are based in Asia, because of course that's where the assets are. 80% of AUM in emerging markets is in Asia, and including our Swedish CIO Jacob, who's based in Hong Kong, China, which is obviously not that common, but I think it's sort of testament to the East Capital view that yes, you can generate alpha in sort of emerging and frontier markets, but you've really got to be there to get a proper feel for what's going on. So that's a really key, so something where we stand out a bit. We then have Hao and Lucy working with Jacob on North Asia essentially. Hao is a Bank of America Merrill Lynch analyst, ex-Bank of America Merrill Lynch analyst, really focused on the tech side, which is the large majority of the benchmark, so the semiconductor names, memory names, all the sort of industrial high-tech producers in China as well. And then Lucy does the consumer names. And I think what's interesting there is, I mean, she really is a living the trends that we're investing in. You know, I mean, she's a 20-something-year-old person actually really looking at all these, using all these apps and these Alibaba new AI app and things like that, and so can give us real sort of on the ground color, as well as just as well as the financial analysis and things like that. Then have Ratish based in India, very senior. He's got buy side and sell side experience, US MBA. Emre in Dubai doing the Middle East and Africa for us. Egle in Stockholm doing Eastern Europe, and I'm the only exception in that I formally cover Latin America, not based there. But yeah, I get there once or twice a year, and obviously meet a lot of companies coming through London. So yeah, it's a nice small team, but works really well. In terms of how we sort of operate, we really big emphasis on just as much communication as possible. Obviously appreciate the downsides of not all being one office. So yeah, morning meeting, everyone will schedule their day around. It's early morning for me, late afternoon for the China team. And then weekly meetings where we'll typically make all our investment decisions, and then we'll try to meet as a whole team at least twice a year. So for example, a few weeks ago we were all in Shanghai, where we met a few companies and brokers, but just spent a long time going through the portfolio in detail. So that's what the team looks like. In terms of the strategy itself, you know, I've talked a bit about the philosophy. I think one of the main sort of differentiating points for the portfolio is the opportunity set we have. So if you look at the large EM managers, they have an average AUM of around 22 billion. And that means they have quite a narrow opportunity set of, 275 names, probably 70 or so of those names aren't very investable. They're Chinese coal companies or something. So, but of course, being a bit smaller, 600 million, we think we have capacity to go up to 5 billion. We have a much larger opportunity set, and that's really what we're trying to exploit when we're going out and meeting companies and screening for exciting companies from our desks. And if you look at our alpha generation since inception, but if you look at the top 10, I mean, it's really nice, broad representation, so across the market cap space. But if you aggregate it, really, all of our alpha has come from companies within the 2 to 10 billion range. So, I think that's really testament to the fact that we're really trying to target this stocks that are sort of just under the radar of the big guys, the Capitals and Wellingtons of this world, but obviously stocks that have similar kind of fundamentals in terms of quality. And things like that. So I mentioned this idea of top down and bottom up, and the main sort of logic is what I took away from managing money in Eastern Europe, which is very easy as a stock picker to not see the wood for the trees. So whenever we're starting to talk about countries, we really first look at the top down. So what's happening on the macro side, politics side, what kind of themes, what's the market structure doing? And then that really makes that we're not just so focused on stocks that we miss other major drivers going on. But then, of course, we do have 7 very clear criteria that we try to follow, consistent with this sort of GARP approach that I mentioned. So the first 3, if you put them all together, very much this idea of sustainable growth. So structural growth, but structural growth combined with long-term competitive advantage, skilled management, but also strong free cash flow, because of course, if you're not generating cash flow, you're unlikely to be able to grow sustainably. You're going to need to go to capital markets consistently. Yeah, we then want to have a different view to consensus, and we want reasonable valuation or significant upside. And then this goes back to this GARP approach. Finally, we have two ESG parts. The first one is an ESG score, which is based on an ESG scorecard that we've implemented since 2016. So this is not a new tool for us whatsoever, but it's very much to assess the sort of non-financial side of a company, really focused on governance. So things like capital allocation, transparency, I guess areas like that. And then also, because we're an Article 9 fund, we have a formal sort of SDG alignment part that we assess and report on, of course, as part of our Article 9. Essentially, what that looks at is in line with, SDG alignment. For us, it's not just revenue alignment, which you find quite arbitrary, but the logic is that, well, at the time we were looking at this Article 9, we're investing in this largest cinema company in India, removed all single-use plastics from its value chain and had a quite aggressive decarbonisation policy. So we thought that actually that company had a positive impact on the SDGs that were material for it. And that's how we look at companies now. So essentially it means that we can invest really across sectors, apart from our exclusions like oil and gas and a lot of mining companies, because they're doing a significant harm. But we're just looking for companies that are sort of acting in a way that's at least in line with sort of market practice, and ideally sort of slightly better in terms of managing these SDG or these sustainability impacts. Yeah, so that's essentially what how the fund works in terms of positioning, or sort of the portfolio construction side. So yeah, it's very much a sort of high conviction portfolio. I mean, it's almost quite easy in emerging markets because they're just such a big opportunity set. We have large focus lists we work with, so as soon as the conviction change, we can just add new names to the list. Country neutral approach is number 2, is extremely important, but I think even more than that, it's very much seeing each of these large countries as mini portfolios. So we're not just picking Indian stocks, trying to build a sort of India portfolio that wouldn't look strange as a standalone India fund, essentially, albeit you might have some more names. And then we have this dynamic approach, as I said, really considering what's actually going on in the country. The obvious one being what works in India at the moment won't necessarily work in China, and vice versa. And then we focus on these medium-sized positions, 1 to 3% active weight, aiming for around 60 stocks in the portfolio, which is almost bang on what we have at the moment. We have a maximum active weight of 4%, and we don't look at the index when we're picking stocks. So if we like a name, we just add it to the benchmark weight. And if we don't like a name, we just won't own it. So we don't have any underweight positions apart from TSMC, just because it's very large in our benchmark. It's 13%, and we're of course a UCITS fund that can't go over 10%. So that's that on the portfolio construction side. I think in terms of the performance overview, I mean, it's obviously been a good period for us with this 4.9% annualized alpha on a gross basis. But what I'm most proud of as a sort of process-focused portfolio manager is that as I said, it's not just during the good times that we performed, and particularly in this sort of mid 2021 to 2023 period, definitely a down cycle in emerging markets, very negative sentiment. We actually delivered alpha during that period, and that's extremely different to many of the growth minded emerging market managers. The reason we did that, the first one was just being able to find exciting stocks that performed, but it's also our ability to slightly sort of shift the portfolio, be a bit more dynamic, and move the sort of styles that we had. And you can see that here, that in 2020 we had over 50% of our holdings in what Morningstar would think of as growth. by mid-2022, it was only 13%. And that's really much a sort of conscious effort by us to reflect what we saw on the sort of the macro side, reflect that in the positioning. So that's moving out of the expensive growth stocks towards some of the more value names like the banks and things that would benefit from this sort of high inflationary, higher rate environment. Yeah, so that's the fund. In terms of positioning and what are the differentiators. I mean, I think I've already mentioned we're country neutral, so it's not really that exciting necessarily to look at the countries, and if you look at the names, probably the first sort of few will be quite familiar, but it's very much after this first five where we get exciting, and then that's consistent with this left-hand chart, which shows sort of weight of various market caps. So yeah, we're an all cap fund. The majority of our fund will always be large cap, but I think it's really this exciting sort of remainder of this sort of smaller mid cap stocks that we think are quite exciting and will drive alpha. And you can see that in our portfolio here with names, for example, like Huaxion Holdings. That's a Chinese company that is one of the world's largest exporters of power meters, one of the world's leading exporters of power meters. So so basically to measure the amount of electricity you're using. Of course, a lot of interest in China because they're upgrading the grid, but they're doing that across the world, in Latin America, in ASEAN, and even in Europe. Actually, they're seeing some exports. So yeah, this is a company that's performed very well. It's up over 100%, I think, in the last few months. But it's these kind of smaller names that are a bit just totally off benchmark, off people's radars that we're trying to trying to find, and that's what drives a lot of our alpha, as I mentioned. In terms of sort of outlook for emerging markets as a whole, I mean, I think emerging markets are very different to how they were when I started investing in them. You know, I think 10 years ago, the emerging market story is very much about sort of economic growth and catch up of growing middle class and growing consumption. That's changed very rapidly now. Whereas if you look at the largest markets, China, Taiwan, Korea, it's actually very much about tech. I mean, Taiwan and Korea almost sort of pure play on some of these sort of AI enablers, if you want to call them that, the picks and shovels of AI, and that's obviously been very positive for emerging markets over the last sort of year and a half, because the hyperscaler capex is just growing and growing and growing. Investors are questioning whether that actually makes sense, but what isn't under question is that money is flowing, sometimes via NVIDIA, to, for example, TSMC in Taiwan that produces all of NVIDIA's chips, or Hynix and Samsung in Korea that produce a lot of the memory chips for the NVIDIA AI servers. So that's something that's very much changed, and this is we really believe these are sort of durable trends that will last, many decades, right? I mean, this isn't just sort of a cyclical thing. The demand for this sort of stuff will just continue. So that's a big driver for emerging markets as a whole. It's been a big driver over the last year and a half. But yeah, we think that will continue. In China as well, it's not so much about the consumer anymore. In fact, the consumer is doing very badly in China, and the economy is not in a great way due to real estate prices. So we have very little consumer exposure. I think what we're really excited about is more of the high technology, sort of highly sophisticated technology exporters that are really the leaders in the world. This is things like, electronic vehicles, robots, even power meters, like I mentioned. So that's I think really a big sort of value driver for both China and emerging markets going forward. So yeah, I think that's broadly how we see the portfolio and the outlook. I mean, clearly it's been a great year and a half for emerging markets, but we think there is more to go. We think just purely on the valuation theme, there's a lot of arguments to really support it. And if you look at valuations here, it's at the start of the month, S&P, growing less fast, trading a lot more expensively. So S&P is trading at 1.5 times this price earnings growth ratio. Emerging markets trading 0.8. our fund's trading at 0.5 times. So, we really think there's still a lot of value on the table, particularly because the arguments that you often saw about lower quality in emerging markets, lower ROE and things like that, starting to become a bit less strong, with the rise of these sort of really high quality tech companies as the largest and main sort of value drivers in emerging markets. So we think that the story's changed and it hasn't quite caught up. And probably the sort of the cherry on the cake is that these sort of arguments are fairly well known, but it's not really reflected in positioning yet. So, at the start of the year, we saw general AUM only 5% was in emerging markets, and if you just look at MSCI, ACWI, ACWI should be at 12-13%, just to be equal weight. So there's definitely more sort of dry powder to come to rotate, particularly in America, where we still speak to people who say, oh no, not much interest in EM yet, haven't really looked at it. So yeah, there's plenty more to go there, and so yeah, I think we remain excited despite the inevitable road bumps that we'll see along the way. So yeah, thank you for your time.